Ladies and gentlemen, good day and welcome to Q2 FY25 and H1 FY25 earnings conference call of Cantabile Retail India Limited, hosted by Phillip Capital, PCG Desk. Before we begin, a brief disclaimer. The presentation which Cantabile Retail India Limited has uploaded on the stock exchange and their website, including the discussion during the call, contains or may contain certain forward-looking statements concerning Cantabile Retail India Limited business, prospects and profitability, which are subject to several risks and uncertainties, and actual results could materially differ from those in such forward-looking statements. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing the star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Renuka from Phillip Capital India Private Limited. Thank you, and over to you, ma'am.
Thank you. Good afternoon, everyone. On behalf of Phillip Capital Private Client Group, I welcome all of you to the Q2 and H1 FY25 earnings conference call of Cantabile Retail India. From the management today, we have Mr. Vijay Bansal, Chairman and MD, Mr. Deepak Bansal, Whole-Time Director, Mr. Basant Goyal, Whole-Time Director, Mr. Shivendra Nigam, CFO, and Mrs. Poonam Chahal, CS. Now, I hand over the conference to Mr. Vijay Bansal for his opening remarks, and then we will open the floor for Q&A. Over to you, sir.
Good evening, everyone. On behalf of Cantabile Retail India Limited, I welcome everyone to the Q2 and H1 FY25 earnings conference call of the company. Joining me on this call is Mr. Deepak Bansal, Whole-Time Director, Mr. Basant Goyal, Whole-Time Director, Mr. Shivendra Nigam, CFO, Ms. Poonam Chahal, CS, and Phillip Capital, our investor relation advisors. I hope everyone had an opportunity to look at our results. The presentation and result release have been uploaded on the stock exchange and our company website. We are pleased to report a good beginning to FY25, with our company achieving an impressive 15.5% volume growth in H1 FY25. This success was accomplished despite challenging market conditions. Our strategic agenda is focused on enhancing customer experience, reinforcing our brand promise, and driving growth through expanded reach into newer markets and diversification across categories. Let me conclude by reiterating our key focus areas: increasing retail presence, enhancing manufacturing capacities, improving efficiencies. We are committed to solidifying our position in the fashion apparel sector. I now hand over the call to Mr. Shivendra Nigam for giving update on the financial and operational performance for the quarter. Thank you.
Thank you, sir. Good evening and a very warm welcome to everyone. Coming to the financials. Performance highlights for Q2 FY25. Revenue from operations for Q2 FY25 grew by 12% to 151.2 crore as compared to 135.1 crore in Q2 FY24. EBITDA for Q2 FY25 stood at 34.6 crore as compared to 29.6 crore in Q2 FY24. EBITDA margin for Q2 FY25 stood at 22.8% as compared to 21.9% in Q2 FY24. PAT for Q2 FY25 stood at 6.6 crore as compared to 7.5 crore in Q2 FY24. PAT margin for Q2 FY25 stood at 4.3%. Performance highlights for H1 FY25. We have achieved revenue from operations for H1 FY25, which has grown by 13% to 279.1 crore as compared to 246.9 crore in H1 FY24. EBITDA for H1 FY25 stood at 73.9 crore as compared to 64 crore in H1 FY25. Our EBITDA margin for half year FY25 stood at 26.5 crore as compared to 25.9 crore in H1 FY24. PAT for H1 25 stood at 18 crore as compared to 19.8 crore in H1 FY24. On the expansion front, the company accelerated its store expansion strategy by opening 23 stores net during H1 FY24. The company operates through 556 retail stores, out of which 425 are the company-owned stores and 135 by franchisee operated. The retail area we are now serving at 7 lakhs plus square feet, which is stand on September 30, 2024. We will now begin the question and answer session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Srijana Mittal from Ratnatarya. Please go ahead.
Hi, thank you for the opportunity. So I have a couple of questions. So one is on the same-store sales growth. For this quarter, our reported same-store sales growth is around 3.48%, right? As per the presentation. Yeah. So firstly, can you help me understand the calculation for that? Like how do we calculate? Actually, like it's not very clear. I think I asked in the last call also, but it's not very clear because we have added about 15% is the store growth, and our sales growth is around 12%. But the newer stores, I'm assuming it would take time for the new stores to become mature, right? So how is the calculation done for the same-store sales growth?
Same-store sales growth, we first completely remove the new stores. Then there are two kinds of stores. One which have completely run for the 12 months last year also and same period this year also. But the store which have come in between last year and this year, they are running for the full time. So this year we are reducing that period for which they operated extra in the previous year. So that's how we're making completely like-to-like growth. So there is no error in it, means there is no error we are making.
And also the same store sales growth what you are taking, that is 3.4% negative side, minus 3% for this quarter.
Correct. That's right. So
it's an apple-to-apple comparison. Whatever the store say in the month of June was operating fully, they have been considered. Same in the July and all this kind of thing. That's like July and September.
Right. So Shivendra ji, what I'm asking is, like why it is surprising to me is because if it's negative 3%, so that means that old stores have not grown. Old stores as in stores which were open last year as well. So the growth which has come, which is in total sales, which we see about 12%, that is entirely from the store additions, right? From the new stores.
You are right. Whatever the expansion is being done, because considering the market scenario specifically or not, first quarter if you have seen, we were being plus 1.3% in value and the volume was actually 4% plus. In this quarter also the volume is good. We are just minus 0.8% in terms of volume. So that is considered this. So new is whatever the growth is come from new stores at minus 3% for the quarter. Overall 6 months minus 1.2%. That's it.
Okay, yeah. And just one more clarity on this. So same-store sales growth, like if I just look at the formula for that, so for this year, this quarter, September 24, when we are calculating, in the denominator, we'll take the stores which were open in September 23 or September 22, or like which one would that be? Like
which has been open in the last year, as explained, opened in the last year, that has been considered this month also.
So like I explained by an example, if some store has been opened in the August last year, so we remove the 4 month period of this year also. Then we will consider the sale of this year from August only and compare apple to apple.
Understood. Okay. So, but that's on 1 year also. Okay, got it. And when we were initially in the start of the year, we were targeting 4 to 5% in same-store sales growth, right?
Right.
So now that this half, we have been short on that. So how do we see the year closing? Do we see some improvement in the same-store sales growth in the second half, or would it be in the similar range?
So considering the market scenario as well as peers, we take the period from the festivity everyone is hoping, and we are also one. So the post-Shraddh period, Shraddh to exactly the Diwali day, 28 days, we have seen a very decent growth in terms of sales in same-store sales growth in these 28 days, apple to apple, like-to-like comparison. And going forward, the season is also going good. So we are hoping, yes, there is a 1.34% negative side, but still we are not revising our any estimate. 4% to 5% what we are on a totality basis for the year should come. Yes, we understand that for this achieving 4% number, we need to have it 7 to 8% growth for the remaining 6 months, and which are very hopeful that should come. Maybe the plus minus 4% is a different thing, but positive, the year should be ended with a positive note.
Understood. Thank you. I just have one other bookkeeping question. So, sorry?
Yeah, Shinda, yeah, right?
Yeah. One other bookkeeping question. So, we used to report job work charges in the PPT for this quarter. Can you share that number, Shirendra, please?
Definitely, I'll share with you. Offline, I'll share with you.
Okay, got it. Thank you.
Thank you. The next question is from the line of Pratik Kotari, an individual investor. Please go ahead.
Sir, good evening. First and foremost, just wanted to check with you in terms of the market scenario right now. We've been hearing that there is some sort of kind of sluggishness in the market of consumer demand. Did you see that as well in the past quarter, and do you see that currently as well? And do you see it improving in the forthcoming quarter? Just wanted to take a sense from you on that.
No, the sluggish demand, yes, we saw in quarter 1 and 2. Quarter 2 it was more and quarter 1 it was less. But in quarter 3 in the running period, we are not seeing the sluggish demand. There is upbound in the demand. And in quarter 2 also the demand was sluggish because there was a preponement of the Shraddh period in which the people used to refrain from the shopping activity. And there was a preponement in the Raksha Bandhan festival also. Last year it was on 30th August and this year it came on 20th August. So 10 days period was sluggish in August also. So now currently the market is upbound.
And so obviously congratulations on good volumes that you've shown the growth on. But any particular reason, if I do a comparative year on year, any particular reason for the fall in margins both on EBITDA and PAT levels, if you could highlight any particular reason which you've seen where margins have seen contraction?
So in our earlier commentary as well, we are continuously saying we have been focused company in terms of managing our gross margin, right? So gross margin has also been improved this side. Yes, once the same store sales growth is only slightly under pressure, so cost is same. So that is why EBITDA margin is on a percentage basis is slightly on a lower side. So that is the main reason. Plus we are opening the new stores, so that will also take time to get mature. So that is what the scenario mainly is. Expenses are there, but same store sales growth would come. That would be recovered.
So over the last some back-to-back quarters, we've seen that the SSG growth has kind of been in the single-digit kind of thing. Obviously, there's been good volume growth, but that is primarily on account of new stores opening is what we believe. Is that the right reason? Or you believe that the SSG growth is robust enough to contribute to the higher EBITDA margin?
No, the quantity in like-to-like also for the first 6 months, has been increase in the 1% in the quantity in the like-to-like sales. And there has been, value-wise, we have decreased by 1.25%. So, purely the quantity is not attributed to the new store opening. The old stores have quantity while in volume-wise they have grown from the last year in the H1. specifically. So for the next next 2 quarters, we are really hopeful.
Okay. And so last question is generally on the inventory. Means, do you think that the inventory levels will continue at the levels of currently, or because of the festivity and in Q3, the inventory levels will be different on account of, means obviously this is relating to the sales itself of Q3. How do you see the inventory panning out over the next 6 months?
Correct. You rightly pointed out. Whenever you have seen our balance sheet for the 30th September, you have seen inventory on a higher side, right?
Right.
Because all the winter inventory has been piled up now. So out of this increased inventory, my cash flow for the first half is majorly goes towards the inventory as on 30th September, right? Because my obviously winter inventory has been piled up. So the bifurcation for this is approximately whatever the cash flow goes, new stores inventory as well as majority in the winter inventory, plus existing base stock on, you can say, 2% has been increased. So this will be rectified and this will be corrected at the end of the year. But overall inventory days, what we have been communicated earlier as well, approximately 120 days would remain same.
Okay. So last question, basically in terms of the festivities right now, in basis your preliminary analysis, you seeing the growth coming in from tier 2, tier 3 kind of towns, or more of rural demand which is kind of built up? Can you throw some light around that? It's just helping us to do the analysis in terms of where the growth is coming in from as well.
The growth is coming from both urban and the rural areas, so there is no dearth of demand in the rural areas now. So demand is equally abound in both the urban and the rural areas.
Okay. Got it, sir. Probably I'll come back in the queue in case of additional question.
Thanks, sir.
Thank you so much.
Thank you. Before taking the next question, we would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Giriraj Dagga from Visaria Family Trust. Please go ahead.
Yeah. Hello, team. So my first question is, did you mention the number of SSG before Diwali, like period? What was that in October? I'm not taking October because festive. Actually, there was a 10 days delay or ahead. Last year, Diwali was 10 days later. So on a like to like, let's say from Navratra till Diwali, what was the SSG?
Like I just said, it's exactly 28 days post Shraddh period till Diwali day. So we have noted a decent amount of SSG. It's a good amount of SSG we have been noted. It is positive. Yeah.
Positive SSG, right?
Yeah, it's a positive SSG and a decent number of SSG.
Okay. I understood. Thanks. Second, when I look at the numbers, like this quarter, we had about 300 basis point of gross margin expansion. And first half also we had about 240 point of gross margin expansion. So first question on when I look at the realization as per your volume has grown up, so realization has gone down actually. So what is driving this gross margin expansion?
So gross margin expansion is against increased on mainly on the some correction in prices. Right? Earlier it was not done, so we have taken the correction in the prices. So mainly gross margin has been expanded as well as volume is also on a positive side in Q1 and very slightly minus on the second side. So mainly the gross margin is increased on those on pricing side.
No, sorry, sir. When you say your total revenue was down, volume was
right.
Small minus, right?
Right. So percentage. So obviously the volume is on the positive side. If you say my overall sales for the 6 months has been down minus 1.3%. However, my volume is plus 1.03%. 1% you can say.
So the realization should be down, right?
Sorry?
Realization should be down.
Realization is down here. Average sale price has gone down. We have passed on the benefit to the customer of the raw material stock correction. Our gross margins have increased because we have markup we have increased. So we have done a revision in the markup of the products we are making.
And this markup will sustain, right? So it's not, we are not going to go back to the earlier gross margin.
This markup is sustainable.
Okay. And you are, I just missed the number. You are continuing with the earlier thought process of about store expansion, somewhere about 80 or 200 store addition, right?
Yeah, we have the same target of 80 to 85 new stores in this year. Though some lesser number of stores have been opened in the Q1, Q2, but in Q3, October, we have only opened 10 stores, and the same kind of number we are opening in the November and December. So the shortfall which we have gone into Q1 and Q2 will be covered up in the Q3.
Okay. And what is the overall capex? Like, what was the full year capex we are looking now?
So same capex is there. Approximately 1700 to 1800 per square feet capex is there in Q1 as well. But however, the biggest store been opening, my H1 store size was 1650 average size. Accordingly, we 70 to 80 stores we have been opening. So approximately on this basis, we can take 20 CR approximately in 20 to 25 CR in terms of capex for store expansion. Plus existing facility, what we have been making for our warehousing, that is required capex as well.
You mentioned some 20 to 25 crore capex.
Yes.
But like first half only we had done about 21 crore of capex, right?
That includes ideally the 20 to 25 crore is for two expansion. One is for store expansion, and what the warehousing facility, come office facility, that will be probably closed by this financial year. So that majority capex is going there as well, which will be finished by this financial year. Approximately that required 15 to 20 crore rupees more by the end of the financial year or first quarter of next financial year.
Okay, so this year capex probably will be about 40 crore.
40 to 50 crore you can take, yes.
Okay, and we will not need any additional equity for this now?
No. Everything from the internal accruals only.
Okay. Sure. Thank you.
Thanks, sir.
The next question is from the line of Pratik Kotari, an individual investor. Please go ahead.
Thanks once again, sir. So just some follow-up questions. Basically, you've seen the volume growth of almost 13% plus in the quarter, whereas the overall value growth was only 12%. I just wanted to kind of correlate in terms of, was there any category change which saw better demand, which was lower in value, or was it that you reduced the prices? What is it that has led to the value downfall compared to the corresponding quarter of last year?
So quantity, if we consider L2L, it's minus 0.75. But overall quantity has been increased to 15%. So major contribution has been done by the new stores. So our accessories contribution is around 5%. So and rest of the garments are 95%. So it has means the same ratio which we have been earlier. So it's not due to the addition of the accessories. It's the same manner due to which the quantity has increased.
So is it fair to assume that accessory hasn't grown to the extent of what you were expecting accessory demand to come in from the stores? Means still we continue to believe that apparel will constitute to have a major pie in terms of our sales going forward as well?
Earlier also, like we expecting accessories to be in this range only, around 6, maybe 7% only, and it's coming in that range only. So we never overestimated the accessories contribution in the total sales. So contribution will be something like this only in future.
Okay. And a related point to revenues was just wanted to reconfirm the guidance for the year. Do we stand to the revenue target and profitability what we had earlier quoted?
Yes, we haven't revised any of the target and very confident to achieve those numbers. So this year, approximately 15, 17, 18% revenue growth would have been there.
And in terms of profitability?
Margins, EBITDA margin should be in the line of 26 to 27%. That is towards in December. And 10% approximately PAT numbers should have been there, maintaining the gross margin 55% plus.
Okay. And coming to the store size in terms of growth, obviously we heard that basically you're going into large pocket stores in terms of size and all. How are they performing in terms of what is the response which you're getting from those kind of stores? Is it becoming value accretive for you in any manner? Is it more still in the experimental stage? What are you seeing on that front?
No, the experience we have got by opening the new store, we think it's a good idea, and we are really successful where we have opened the bigger stores, I mean. And even the retail cost of the bigger stores is lesser than the smaller stores. If they have a better EBITDA margin, the bigger stores have. So we will be going with the bigger stores only in the future.
So your indications in terms of PSF on these larger stores is much better compared to your traditional size stores, is what we have to estimate?
So bigger stores tend to have a lower PSA, but that's the norm of the industry, because when you increase the store, the PSA tend to go down, but your EBITDA margin shouldn't go down, your realization shouldn't go down. So those things are maintained, and even better, the profitability is better in the bigger stores.
Okay. So on the EBITDA front, you will probably see an uptick, is what you're saying, on account of increase in larger stores.
Yeah. Yes, sir. On company level. Absolutely.
And in terms of what would be that number of bigger stores today, means if I have to put that number into perspective,
so we
how
have
many bigger stores would have been already operational?
So we have 20% family stores. So these are the bigger stores. We have 30% as the men's and the ladies, and our 45% stores are only menswear store, and 5% stores we are doing ladies and kids. So you can say 20% are the bigger stores.
Okay, understood. And last quick question was on the split between online and offline. Obviously, in the previous calls, you've highlighted about your digital penetration and all. Are you seeing an uptick there as well in terms of online penetration? What would be the split?
So the split as of now, overall guidance is same for the year, but from the YOY basis, quarter on quarter, also the growth is there. Last year, out of this, we have been in Q2 approximately 6.5 crore out of total revenue of 135 crore. And this year, out of 152 crore, approximately 10 crore has already been achieved. So
in the online space, from the online
e-commerce space, yes, correct, e-commerce space. So overall, the numbers are coming as per our expectation, and annual guidance is same.
Thank you, sir. Thank you so much. That's all from my end. Thank you,
sir.
Thank you. Ladies and gentlemen, if you wish to ask a question to the management, you may press star and 1 on your touchtone telephone. The next question is from the line of Aman, an individual investor. Please go ahead.
Yeah. Hi, sir. Am I audible?
Yes, sir. Yes, Aman. Yeah.
Okay. So, sir, my question is, if we look at the organized retail sector, like fast fashion is the growth engine for many of the peers. Is there any component of fast fashion kind of products in our current product portfolio, or are we looking for such kind of addition in future in our stores?
Yeah, we have planning to add the fast fashion kind of products in our collection. So we are planning to go with the 25% of the collection should be in the category of fast fashion. But majority of the brand is about the basic fashion, minimalistic fashion. So we can't change the DNA of the brand completely. But yes, we are inculcating the fast fashion element and components in the collection.
Okay. So basically, my idea of question was basically, the fast fashion is growing about 35% kind of CAGR. So that was the logic.
No, your logic is right. So there is no denial in that. So we are changing ourselves a little.
Okay. Thank you, sir.
Thanks, sir. Thank you.
The next question is from the line of Aman Vishwakarma from Phillip Capital. Please go ahead.
Hello. So I had a question on your, to begin with the store addition. So you set a target of 80-90 stores every year for the next couple of years, right? So this expansion, so what are the regions that we are planning to expand in T3 or T4 or T1, T2?
So we have present on all the three categories, Tier 1, 2 and the 3. So 20% of the stores are in the Tier 1 town, 40% in Tier 2 and 40% in Tier 3 towns. So and the retail cost is lesser in the Tier 2 and 3 towns. So that's why we have going in the Tier 2 and 3 towns, and company has a good traction in the Tier 2, 3 towns and good brand awareness in these towns. and the company's ASP is very suitable for the smaller towns. So that's why we are going in these towns.
Okay. And second question would be on your fast fashion thing that you mentioned earlier. So, I mean, so do we have the design capability for it and maybe the logistics that we need to go with it?
Yeah, we have a design capability. We have a team of designers who are working on the fast fashion kind of stuff also. So we will be soon introducing the little fast fashion categories in the collection, and logistic capabilities there. Yeah.
Okay. And just lastly, so I see your stores being very skewed towards men's fashion, right? So do you not think to some extent that limits our ability to charge a premium to the customers? So would it not make more sense to have more occasional wear for women that would enable us to, go up the value chain? And what is your thought process?
We are not planning the occasional wear for the ladies stuff. But yes, because Canterbury is predominantly men's and the customer sometimes don't know that Canterbury is offering ladies collection also. So we are opening ladies and kids exclusive stores also. So that stores are highlighting the Canterbury ladies collection, and they are providing good response to us.
Okay, so what would be the revenue share like between the two, the ladies wear and the men's wear? So maybe years down the line, how do you see that panning out?
So right now we have like 83% the menswear, 10% ladies wear, and 5% accessories, and rest is the kids wear. But in the future we see that ladies wear component should go up, like 12-13% it should come.
Okay, got it. I'll come back in queue.
Thank you.
Thank you. A reminder to all participants that you may press star and 1 to ask a question. The next question is from the line of Dhiral Shah from Phillip Capital. Please go ahead.
Yeah, good afternoon, sir. Thanks for the opportunity. Sir, just wanted to know what is the, reason for the higher depreciation, in the P&L side, since we have not opened much store in H1, and what will be the run rate going ahead?
So depreciation is there. Since, if you see, for last 1.5 years, we have opened approximately 90 plus stores, approximately 100 stores, and out of which 90 plus are the company-owned stores. And now, since the size is bigger in terms of the stores, 16 million square feet, so obviously capex is more. The more capex is there, the more depreciation is there. Now, considering this Ind AS 116, the higher depreciation is accumulated because of Ind AS 116 working. All the lease rental has been converted. So the more we are opening the bigger stores as well as company-owned stores, depreciation and finance costs would increase.
So will this not impact our profitability in terms of our profit after tax?
So yes, that is why we are giving separate slides in terms of Ind AS, pre-Ind AS, post-Ind AS. Whatever the number is being shown, that has been lesser 1.25 per quarter in terms of profitability. Actual profitability before Ind AS is 2 crore. And then on a purely non-Indian side also, well, the bigger stores would be there and capex would be there, so slightly depreciation would be on a higher side. Yes.
Okay. And sir, in terms of demand outlook or on the volume side, so are we seeing more interest coming from the tier 2, tier 3 cities, or it is also from metro and urban cities?
We are expecting the same upbound in the market in both tier 1 and tier 2 towns. So there is no difference between the demand in the two.
So this 13% volume growth that we have seen in Q2, so is it equally from the metro and the the tier 2 and tier 3 cities?
Yeah, it's equally between the two. Yeah.
Okay. And so what was the growth on the online channel side in this quarter particularly? Since, in H1 we have seen 32% growth, but particularly for this quarter in Q2, what was the growth? And what is the outlook on the online sales, channel going ahead?
So as I just replied, There is a online growth as well. So last year 6.5% as compared to this quarter is 10.5%. So definitely growth is good in terms of online. And overall guidance, as we said earlier, last year we did approximately 5.5 CR. This year we have a target of approximately 7% of total revenue that was going to be achieved. Yeah.
Okay. And sir, in the coming years, let's say over next 2 years, are we planning to take it to double digit?
So yes, when we have been always said we are targeting to make the company the 1,000 crore revenue company by FY27, and that time we have seen a contribution for e-commerce approximately 8 to 10%. So from here onward, we can take it to the double digit.
Okay. And sir, lastly, we had 1,000 crore of kind of a revenue that we are, aspiring to. So what will be the product category mix, between menswear, womenswear, or maybe even kidswear and accessories? What are we targeting, sir?
So when we'll be doing like 1,000 CR, so ladies and kids category contribution will increase. So ladies category should be between 15 to 20%, and the kids category we're expecting something like 6-7% that time.
And so what will be our strategy to, increase the share, particularly on the women's category side? Are we planning some new product launches over there, to improve the pie or maybe to increase their contribution, in the stores that we manage?
So we are adding new ladies and kids exclusive stores, through which we are planning to take the contribution of ladies and kids up in the total sales.
So existing share, if you see the bigger stores will contribute. If you see last year, it's growing 8%, 9%, we are expecting 12%. So that is why bigger stores is there, which includes contribution in terms of ladies more, as well as exclusive stores, which is approximately 40 plus now.
Okay. And so when it comes to the average selling price, what would be the difference, between the categories, let's say menswear, kidswear, or even womenswear?
So ASP is more or less the same in the men's and the ladies, but yes, it's slightly lesser in the kids wear.
Okay. Even the accessories would remain at the same range?
That is lower. That is obviously lower.
Okay. And so just last one question. In terms of our EBITDA margin over next 2 to 3 years, is there any room for further improvement that we may see, from the current range, or maybe it will remain the same even going ahead?
So we have set up a higher benchmark. So whatever the numbers we have achieved in FY23, when we are talking about the 1,000 crore, we are trying to come back on those numbers. 26 to 27% EBITDA margin now. It can go up to 28 to 30% in coming years.
Okay. And sir, if may I ask, what will be the, margin driver going ahead to take it to 28 to 30%?
So same 4 to 5% of the same store sales growth we are expecting, which was obviously not there last year, and this year we are more because the contribution is fixed. We are robusting our gross margin, so this EBITDA margin uptick should be 2 to 3% would have been there.
Okay, sure. Thank you so much, sir. That's it from my side.
Thank you, sir.
Thank you. The next question is from the line of Meet Raj from Equirus PMS. Please go ahead.
Yeah, thanks for the opportunity. 2 questions from my side. First is again related to fast fashion. So, basically, what is the launch timeline for this category? Related question is, across how many stores we are planning to introduce fast fashion? Will it be only in the family stores or other stores as well?
So like we will be moderating our current collection, so it will be going to the every store, and so we will not be adding the new SKU, but we'll be modifying the old collection into a portion of it into a fast fashion collection. So it will be available in all these stores.
Okay. And will it be a material margin difference of fast fashion clothing versus your normal clothing?
Not exactly. The overall we are targeting plus minus 1%, 1.5%, 2% is any category is different and depends on the product, right? But overall gross margin what we are maintaining, that would be there 55 to 56%. That is the overall target.
Okay. Second question is in terms of your FY27 revenue. When you say 1,000 crore of revenue and with higher EBITDA margin of closer to 29%-30%. So, do we still maintain our earlier guidance of 120 to 125 crores of net profit in FY27?
Percentage would be there, what I mentioned. We are trying to reach that 10% as of now. So there is always shown in terms of PAT margin, 10 to 11%, 12%, and 26, 27, this will we are delivering now. The moment going forward, a 1 to 2% uptake would have been there.
Okay. And last question, in terms of accessories category. So, can you tell the exact margin of accessories? Is it materially lower than your clothing category?
As I just mentioned, all the margins we are operating on plus 50%, 52, 53. Approximately 1 or 2% margin on category wise is different, but overall margin is lying in all the categories above 50% and somewhere 55 to 56%.
Okay. Got it. Thank you so much.
Thanks, sir.
Thank you. As there are no further questions from the participants, I would like to hand the conference over to the management for their closing comments.
I would like to once again thank you all for joining us on this call today. We hope we have been able to answer your queries. Please feel free to reach out to our CFO or IR team for any clarification or feedback. Thank you all.
Thank you, sir.
On behalf of Phillip Capital India Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.